Hi, this is Alessio, Rastani of Leading Trader. Hope you're well. In this video, I'm going to answer two of your most important questions, which many of you have been asking me. Firstly, the question you've been asking is, why are the stock markets dropping? And secondly, what impact could a possible trade war or the new trade tariffs have on the global economy and the stock markets? In fact, I'm going to show you there's an important link with the 1929 stock market crash that happened and the Great Depression that followed, because there's a lot of evidence that suggests that there is a connection between trade tariffs and the stock market crash that followed. So let me begin first of all by taking a look at the chart of the S&P, and we'll take a look at the chart of the Dow as well in this video. Now, what we can see here is, first of all, that very likely the stock markets formed a wave 3 top back in January. As you can see here, we peaked there. And the S&P then subsequently had a sudden drop, a very nasty drop, as you can see here, formed a possible wave 4 correction about there. And since then, all we've been doing so far is forming this very nasty, very wibbly wobbly kind of corrective wave that you can see here. And in fact, just recently, as you can see here, the markets yet again have been dropping in the last few days. Now, here's an interesting thing, which you can see on my chart. Firstly, notice where we are in relation to the 200 moving average, that green line you see on my chart. Notice we're not far away from it. And something interesting you'll notice is, notice how many times we've been touching this green line, this 200 moving average. Once back in February, again in April and March, again in May, and are we going to test it again? Are we going to come back to this 200 moving average again? And here's something you should know. In technical analysis or chart analysis, the more often price comes to touch a certain level, the more likely it's going to break it and fall below that level. And that's not all. Notice this key level you see on my chart, at 25.81. Let me make this very clear. As long as the stock market remains above this key level, 25.81, which is, by the way, a key support level. Notice that this is the support level we formed back in February, in April, and you might say even recently. But bottom line is, this is a key support level, 25.81. Make sure you keep that in mind, because as long as the stock market remains above that level and stays above it, the path of least resistance is higher. In other words, as long as we remain above that level, 25.81, I'm bullish in the stock markets. I still think there's a chance that we might come back and test the January highs. However, if the stock markets were to drop below that level, in other words, if we saw more volatility in the stock markets, and if the S&P were to fall below the lows of February and April, in other words, below 25.81, and if we stay below 25.81, then we'll have to change our minds. And that, of course, will mean it's a great likelihood, very great probability, we're heading for a bear market. Make no mistake, this level is absolutely fundamental and important to the stock markets, 25.81, because if we were to drop below it and stay below it, the odds greatly increase we're heading towards a bear market. Now, you might ask this question, why would the stock markets drop below the lows of February and April? In fact, what possible reason could there be? What possible event could happen in the next few weeks or the next few months that could drive the stock market to those levels? Now, again, remember guys, I don't expect that's going to happen. I don't think it's likely that's going to happen. But let's say it did. What could possibly trigger it? You see guys, as I'm sure you probably heard in the news, one of the major things that's making investors and the stock markets very nervous is a possible trade war, not just with China, but also other countries around the world. Now, we already have heard that China is threatening to retaliate against any trade tariffs that US may impose. And we already know the US has imposed trade tariffs on the aluminium and steel imports. Now, before I discuss the connection between trade tariffs and the Great Depression, let me just make this very clear, guys. By no means am I political. I don't care about left-wing or right-wing politics. I'm sure that many of you, like me, don't care about politics, period. All I care about is to find out the truth and find out the facts about what is the connection between trade tariffs or a trade war and the stock markets. What is the likely connection? And is there any historical evidence that could back this up? There is. So guys, let me take you back to October 1929, before the stock markets crashed. You see guys, back in 1929, before the markets crashed, there were talks of a possible new law called the Smoot-Hawley Tariff Act that was going to impose trade tariffs on other countries. Now, here's the thing. That law, the Smoot-Hawley Tariff Act, did not get passed until after the markets crashed. In fact, that law got passed in the middle of 1930. So many people argue, many economists argue, that trade tariffs could not possibly have caused the stock market crash of 1929. But here's the thing. Almost every single economist does agree on one thing, that the trade tariffs did greatly increase the duration of the Great Depression. So the reason why the Great Depression lasted so long as it did, in fact, it lasted all the way into 1933, 1934, the reason they say is because of this Trade Tariff Act that imposed tariffs on other countries. Now, here's the thing. Not everybody agrees with that interpretation. There are some economists that say, actually, you know what? That law brought about and caused the stock market crash of 1929. So you're probably wondering, well, how did it do that? Let me read you from this article, which is titled, Did Trade Tariffs Cause the Great Depression? So in 1979, a National Review analysis of the causes of the Depression, author Alan Reynolds argued that Smoot-Hawley, in other words, the act that imposed trade tariffs, Smoot-Hawley was an ongoing drag on the economy. More than that, though, he thought it substantially contributed to the stock market collapse of 1929 because traders saw it coming. Guys, that is the key phrase right there. You see, guys, as many of you, I'm sure you're aware, the stock markets, and in fact all major markets, act in advance, many months in advance of what's going to happen. Remember, guys, that the markets are forward thinking. What we're seeing happening right now on the major markets, so what you're seeing happening on the stock markets right now, or on different markets too, not just stock markets, but also on Forex and also on Bitcoin, cryptocurrencies, it doesn't matter. You see, guys, what you see on the chart and what you see happening on the price is based on the bets that investors are making many months in advance. So remember, what you see happening on the stock markets are the speculations and the bets that investors and traders are making 6 months down the line. And that is precisely what some economists say is what caused the stock market crash of 1929, because many traders at this point they knew that this law was going to get passed on trade tariffs, and they were not going to sit and wait until it got passed in 1930 to take action. No, they took action months and, of course, almost a year in advance. And that, of course, is what caused the stock market crash of 1929. Let me read you more from this article. Smoot-Hawley, Reynolds points out, passed the House in May 1929, and stocks were battered every time the act moved through the legislative process. On October 23rd of that year, a Wednesday, it became clear the tariffs would be much broader than first believed. The very next day, of course, was Black Thursday. Markets dropped 9% in a day and kicked off a years-long stock meltdown. As Reynolds sums up, market participants do not wait for a major law to pass before retrenching their positions. Again, that's what I just mentioned a few minutes ago. In 1929, they were right to sell. Smoot-Hawley ultimately raised tariffs on tens of thousands of products, and trade policy analyst Bill Christ points out that by the end of 1934, global trade had tanked by 66% from 1929 levels. Guys, that is a very important thing to appreciate. The reason why the markets are so nervous right now, and why, of course, they're moving in the way they are, so much volatility, is because investors, just like back in 1929, are nervous about the consequences of trade tariffs. And again, guys, remember, I'm not interested in the politics. Maybe you agree with the trade tariffs, maybe you don't. The bottom line is the stock markets and investors and traders around the world, they don't like these trade tariffs because they see it as being negative on the overall economy. The question that many investors are asking right now is this. Firstly, there are two things we don't know. Number one, how extensive and broad are these trade tariffs are going to be? And could it lead to a possible trade war? What are the consequences? How will China react? Will China retaliate in a very strong negative way? How will Europe act? These are great uncertainties. Let's remember, investors, the traders around the world, the big money, the big players, they're not going to sit around and wait and see what's going to happen next year. They're going to make their decisions now. They're making their bets and they're placing their bets right now. That's why, guys, you need to pay attention to this key level that I showed you just a few moments ago, 2581. Because if the stock markets see more volatility, if we fall below the 200 average, and if we come down here, okay, let's say, for example, in the next few weeks or the next few months, we come down and we take out 2581. So in other words, let's say we fall below 2581. If that happens, the markets and investors are sending you a big, bold message. And that message is, we're out of here. In other words, we're heading for a bear market. All right, guys? So that's a key thing to bear in mind. And of course, if that happens, if we fall below 2581, that means the wave count here will also change. We'll have to change and rethink our wave counts. Now guys, before I finish this video, I just want to say one more thing, which is that in Sunday's premium video, I'm going to go into a lot more detail about the stock markets. I'm going to show you exactly which opportunities and which trade setups I'm looking at on the stock markets, on the S&P and the Dow. And I'm going to show you exactly which key leading indicators we're looking at as well. That's in Sunday's premium video. Don't miss it. And guys, if you found this video to be useful, please give it a thumbs up. And also please remember to subscribe to our videos for future updates. Thanks very much indeed.